Hi again, everyone. Welcome to another financial analysis video with myself, Moeed Amin, and Ted Wayman. Today, we're looking at Opendoor. So, an interesting business. They're one of, I think, 3 companies in the US that are seeking to digitalize the real estate buying and selling experience. So, just a quick note on Opendoor and what they do. They basically buy houses, residential real estate. So they buy residential real estate from people. They make an all cash offer to them, and they claim to be able to do that within, say, 48 hours. Now, one important thing to note is if you're analyzing this company is they typically buy and sell houses within the $125,000 mark to $500,000 mark. So any houses you might have outside of that bracket might be less likely that they will purchase from you and sell that house, sorry. So when they make the cash offer, they also kind of repair that house, do any kind of upgrades to it, and then they will sell that house on to any interested buyers. Now, a couple of things to note as well about this business is they recently acquired 2 companies, Pro.com and Skylight, which are digital home improvement services. Now, what's interesting is that they're actually going to discontinue those businesses. So they bought them because they were a competition, and they've essentially shut them down. Now, this won't be reflected in the finances we're analyzing today, but it is something to look out for in the future reporting. The other thing to note is that they also provide financing services. So we're going to look into that hopefully a bit more when we look at the financial statements. Now, the stock price has been a bit of a pyramid shape. So it's gone up and it's come down. If you invested at the beginning when they first floated, you would have made a profit, but you certainly would have been holding on for dear life as they've been going through that journey. So we're going to be looking at that business in a moment. Before we do so, just a reminder to everyone, do like, share, and subscribe. If you are a subscriber, I would say 95% of our videos, Ted, comes from viewer requests. So one particular individual requested this one, so trade for rice. Here is your video. Since you're a subscriber, you will get instant notification of when we've published this video, so you don't have to keep searching for it and waiting for it. You will be informed. So let's go straight into it, Ted. What have we found out in terms of their financials? Let's share that with everyone.
Okay, well, good to see you, Moeed, and thank you very much. Yeah, so Opendoor, quite an interesting business. I was, when I was kind of looking through these financials, I was thinking WeBuyAnyCar.com, very big here in the UK. Maybe they're kind of WeBuyAlmostAnyHouse.com. And really just taking the effort out of selling your house, the stress, but obviously you're going to be selling it at a lower price, perhaps than you could get if you put it onto the market and were prepared to deal with estate agents yourself. So we're going to be looking at the financials. Here we are. It's the 10K. Now, there are some later figures available, so this is not the latest set of accounts. And once again, if you're going to give me that kind of comment that says this is a very backward-looking analysis, welcome to the world of finance. Financial statements tell us what happened in the past. They do not tell us what happened in the future. So if you have any comments, you want to talk about latest deals or opportunities or market size or why you think the company is a buy, or a sell, or whatever, welcome to add them into the comments. All we're doing here is the financial analysis. We're looking at the performance of the company in their annual report and accounts. So we're going to scroll down to these financial statements. And so here we are looking at the income statement, the profit and loss account, or the statement of operations, where we are showing the trading account. And you'll notice that this is stated in thousands of dollars. So 2018 revenue was about 1.8 thousand million, so 1.8 billion. Rose very significantly, 158% increase in the top line to 2019, and is a sense then halved. So maybe there's a kind of reflection in the pyramid shape you were discussing, Moeed, of the share price all the way up and all the way back down again. Revenue all the way up and all the way back down again. Is that pandemic related? I don't know. But anyway, so the revenue has come down significantly. The cost of revenue is high. Okay, so the cost of revenue, and as we kind of expect, so this cost of revenue is anywhere between 94 and 91% of sales. So these guys are making less than a 10% gross margin on these houses. And that kind of makes sense because, you know, if I'm going to be selling my biggest asset, which is what a house generally is for most people, if I'm really going to be selling my biggest asset, I don't want to be selling it at much lower than I could get it for, you know, if I made the effort to kind of deal with estate agents. So this is really dealing with people who are maybe a little bit distressed. Maybe they just don't want the hassle or the uncertainty, and they just want to know that when I want to sell my house, I can sell it and buy that next one, which I've always wanted, for example. So they're kind of taking the hassle out of it, and they're making a small profit. So 2020 figures, we can see they are making a small gross profit on the buying and selling of houses, $220 million. As I said, that's 9% of the revenue. And then we've got the cost of running the business, the cost of the operations. You mentioned that they are a technology business. So here is the kind of the investment going on in their technology and development, but they've also got sales, general and administrative charges, which together are pretty high. So if you're making a $220 million profit on the sale of houses and it costs you another $405 or $406 million to run the business, you can see pretty quickly that they are making a loss. And this is pretty consistent, this loss. In terms of the loss margin, anywhere between 7 and 9%, depending on which year you are looking at. So making a loss, and you can start to see here that, you know, there's a scalability aspect about this business. So they really need to scale up, and as they scale up, these numbers are going to grow. These numbers will grow, but they're hoping they won't grow as much. So a technology company, all about a kind of that play, and what they're trying to do is to kind of, you know, is to leverage the fixed cost base and start making profits. Okay, but you can see that, you know, they've got some way to go. They really need to be, you know, a pretty big dominant market player, and that is what their plan is. Couple of other things to notice. We've got certainly there's some interest expense down here, which means that they're going to have debt sitting on their balance sheet. You'll notice that the debt has come down significantly. So they really felt they had too much debt on, and they've reduced that debt. And they also took a hit on the cost of reducing that debt. So there had been an early repayment penalty clauses, for example, and they'd have just taken that hit and said, we can't carry on paying $109, $110 million a year in interest. So bottom line, they're making losses, and they are probably going to make losses for a while to come, especially if they're going to struggle to get that revenue to go back up again, because they really need to be kind of accelerating that revenue. And obviously in here, we've got our sales and marketing. These are the guys responsible for that sales and marketing, but there needs to be a mind shift. You know, there needs to be people who just go, actually, I'm going to use these guys rather than the traditional way of selling my house. So there's the income statement. Let's go and have a look at the balance sheet. So the balance sheet is just before the income statement. Here it is. So we see in terms of their current assets. So you remember the current assets, these bits up here. This is the stuff that we have, which is either going to become cash or already is cash. And what we can see is up the top, they're sitting on a lot of cash, a significant increase from the previous year, $1.4 billion in cash. So it looks to me like they'll have raised some money, and we'll see that confirmed in the cash flow statement. So significant increase in cash. They've also got quite a lot of inventory. So this line here is the kind of the real estate inventory. So these are the houses that they're sitting on, that they've bought from the original owners, that they are then, you know, effectively doing up before they actually sell them. Again, you'll notice a significant decrease in inventory. And there's a little bit of escrow receivable. So this is kind of money which they are due to receive from the sale of houses. So relatively smaller. And that's kind of, those are the kind of the big numbers in there. The non-current assets, pretty small. So there's really very little to sort of talk about in there. They've got some property, plant and equipment, which is on lease, and they've also got a bit of goodwill. The goodwill reflecting the fact that they have, they have been buying other companies. So, this is a company which will have grown by buying other similar companies. And as you mentioned, they bought some companies just recently, but that's not reflected in these numbers. And we can see that because the goodwill hasn't changed year on year. So total assets, just under $2.2 billion. Looking at the liabilities, so first of all, we see in the current liabilities have fallen significantly. So current liabilities, amounts we owe and we have to pay soon, fallen significantly. The main reason for that fall is this line here, which is the current portion of debt. And as we talked about, we saw with the interest has fallen, their debt has fallen as well. So they have paid off a lot of that long-term debt. And just to sort of double check that, we can see that, here's the other side of the debt sitting in the non-current. And again, there's been a reduction there. So we can see on the balance sheet, the debt has been coming down. And so total liabilities, significant drop in the total liabilities while the assets have remained pretty much the same. And again, that's mainly driven by the fact that they've raised money. They've used some of that money to pay off the debt, and the rest of the money they've got sitting in the bank account, ready to fund their future operations. Coming down to the equity, quite interesting in terms of the equity. We see all of the kind of the investment, and this is they've actually got it down as temporary equity, has effectively been eliminated. And in effect, what we're going to see here is that this company has floated through a SPAC. So, a SPAC is a special purpose acquisition vehicle, and effectively, rather than Opendoor going through the process of selling its shares and justifying it and raising money, a SPAC has been set up. This is a shell company. It just raises the money, and then this company is effectively reversed into that SPAC. So if you own shares in the SPAC, you now effectively own shares in Opendoor. So effectively, that has really been sort of converted into this kind of additional paid-in capital down here. And then we notice down here, there's the accumulated deficit because the company has been trading at a loss and has yet to make a profit. So there is our balance sheet. So the balance sheet, in terms of the strength of the company, it's looking pretty high. It's looking pretty good. It's got lots of cash. The debt has come down. However, it's hunkering down, ready for the kind of the trading, the next few years trading, when it needs to kind of hit that terminal velocity and start generating the profits that it needs to survive. Okay, so let's have a look at their cash flow statement, and quite interesting, the cash flow statement. So the first section, this bit here, is all about turning an accounting profit into the cash profit. Now, as we talked about, accounting profit is actually accounting loss. So this is from the profit and loss account. They're making a loss. And you'll notice that they were burning cash in 2018 to the tune of $1 billion a year. They reduced that in 2019, and now they've actually turned the corner, and they're actually generating cash. So this is really interesting that they have managed to to generate more cash than they're burning. Now, why is that? Well, if we look at the numbers, we see here that they have, this is their real estate inventories. This is a positive number. So this means that they have sold more properties than they have bought. So if you remember in the balance sheet we were looking at, they had a lot of inventory at the end of last year and much less inventory at the end of this year. So if you think about it a bit like a warehouse, if your warehouse goes down, you're actually releasing the cash that is tied up. So I suppose the point to make is that, this is a one-off. You can't spend more money, so you can't sell more properties than you are buying on an ongoing basis, because effectively you run out of properties. So what's quite interesting about this business is that, there's a nice story here: big negative cash flow, little negative cash flow, positive cash flow. But the question is that sustainable for the future? And my guess is that it's not. And my bet would be that for 2021, unless there's a significant change otherwise, we're going to see negative cash flow again. So the cash flow looks positive, but there's one-off items in there which are unsustainable. In terms of the investing activities, they've got a lot of, we have to basically remove these 2 points here. These are buying multiple securities and selling multiple securities, which for us is basically them parking cash on one side. So when they buy a multiple security, think of it like a deposit account. It isn't, it's a bond, but it's like a deposit account. If you've got a lot of cash, you park it on one side, and when you need it, you bring it back out again. So this is them moving money onto one side and moving it back again. It's not really investing in the business. Investing in the business is this number. It's very small, but then they're a technology company. They don't really need to be buying a lot of tables and chairs and buildings and manufacturing equipment, for example. So investing activities, pretty small. And then we come down to the bottom half with the financing activities. And here we can see from the financing activities, there's the proceeds from the SPAC. So that's the kind of the flotation reversal into the SPAC. There's a little bit of this is a refinancing going on, and if you notice, the proceeds from borrowings and the payments on borrowing, certainly in this year, the repayments are higher than the proceeds, reflecting the reduction in debt. So really, what we're saying here is that this company, they've generated cash because they've sold down. They had, you could almost argue, too many properties in the warehouse, and they've sold those down. So they've generated more cash than they made in profits, or rather they've covered their losses. They've generated cash by selling down properties that they had in the warehouse at the end of last year. They've raised a whole lot of money by their reversal into the SPAC, and then they've used some of that money to pay down their debt. And that's why at the end of the year, they're sitting on about $1.5 billion of cash. So that $1.5 billion of cash, on the basis that we don't expect this 681 million of cash flow to continue, if they are operating, let's say, even if it's a $250,000 cash burn, that gives them what's that, about 6 years of kind of headroom in order to kind of get this business going. So, this is a company, they're sitting on lots of cash. They are operating at a loss. They are probably burning cash, would be my guess. And they are looking to, to kind of reset and restart after the wobble in 2020 and start to grow this business, hit the profit line, start to generate cash, and start to generate the return to the shareholders. So yeah, there's the kind of, there's the sort of the real story. There's nothing else really, I think, to sort of say about them. Their liquidity ratio is very, very healthy indeed. In terms of their working capital requirements, so this is kind of looking at money in, money out. They don't really run accounts payable or accounts receivable. When they buy a property, they pay for it, and when they sell a property, they receive the money in. So what they're really looking at is the challenge of their inventory days, and based on these numbers, they're holding their inventory for about 137 days, which is quite a long time. But they're trying to reduce that, so they are bringing their stock down. But this is the dilemma, because if you bring your stock down, it means you're not buying houses, and they're going to need that cash to buy houses, because that's their business model. They've got to grow, and by growing, what you do is you buy more and more houses. It's also very dependent on the sustained, the upward growth in the housing market. So, one of the alarm bells we want to be aware of with this company is the fact that if the Federal Reserve start tightening and they start raising interest rates, then potentially the asset price, the housing price bubble will start to come off, and house prices will level out and maybe start to fall. And suddenly these guys could get caught in a really nasty situation where they're sitting on a lot of inventory that they're struggling to sell and start booking losses. Okay, so it's just to be aware that this is a play on the continued buoyancy in the housing market. So let's look at their share price. So here it is. There's no price to earnings ratio, obviously, because there's no earnings. So their share price is, their market capitalization is $11.8 billion, which is pretty much all goodwill, because they've got 1.6 billion of net assets, and that 1.6 billion of net assets basically reflects the cash in the banks. So this is all goodwill. 5 times sales. I don't know if that's a good metric. I'm not sure. It looks to me like it's quite a punchy valuation. I think that there's a lot of good stories in this business, and I think all of those good stories are reflected in the share price. So my personal opinion is it's been burning cash. It's going to carry on burning cash for a while. It's going to be carrying on making losses for a while. They're going to try and invest to hit that velocity. They've got the cash to sustain the business, but they're going to have to build that stock back up. And it's the big if the housing market starts to wobble, these guys are toast effectively.
Yeah, that's a great analysis, and it'll be interesting to see with what's been happening in the housing market this year, 2021. It's been growing. There's been a lot of buying and selling at the moment in the US, as well as other countries around the world. How will Opendoor fare? But as you say, yeah, spot on. If the Fed do start to tighten monetary policy, what impact is that going to have on Opendoor? So there you have it. One thing I did forget to mention is, and it's important for your investment thesis, is that recently they announced there's a second offering of 20. So an existing investor is seeking to sell 28 million of his or her shares. So make of that what you will, but it's certainly important to put into your investment thesis. So Ted,
count me out of that one, Moeed.
I don't think I'll buy that either. So thank you very much, Ted. This was useful. Again, don't forget to like, share, subscribe, particularly if you made a request for a company you want us to analyze. By being a subscriber, you will get instant notification of when we publish your video. So until the next video, thank you, everyone. Thank you, Ted.
See you later, Moeed.